Welcome back here with the CNBC TV18 Diwali Masterclass, and now the floor is open for questions, and we have a very vibrant, audience, a mix of all age groups and a couple of students as well. So I promise all three of you gentlemen that this is going to be an interesting one. Let's start with Mit Ambani's question. Mit, hi, welcome to the show.
Thank you so much. So basically my question is, despite the perception that, currently mid-caps are somewhat overvalued, considering that, is there any specific sector in the mid-cap space that can be a potential in the near term? So what do you think on, what is your take on that?
Okay. There are a couple of questions on Midcap, so allow me to, bring all the questions together and then I'll toss it to our panel of experts. So you are looking for Midcaps which can still offer some good return. Basically, that's your question. Got it. Shivam, I think, also has a question. Shivam, you have a question on Midcaps?
Yeah, thank you for the opportunity. My question on Midcap is bit related to MFs. Now, as we see, Midcap is not a very broad-based universe, 150 stocks, as compared to, say, small cap where we have 5,000 odd stocks. Now, Midcaps is not also as liquid as large caps, which starts from, say, 47,000 crore and goes up to 17 lakh crore. So, in scenarios like this, are we seeing a bit stretched valuation wherein reports are coming out on mid-cap saying that it is bit overstretched? And is too much money chasing too few stocks in the mid-cap? So that's my question on mid-cap.
Okay, so I think the order is basically your question first, whether mid-caps are overvalued, and then even within an overvalued space, what can you still buy? I think we'll go in that order. So, Nilesh, you want to take this first to begin with?
Sure. So, beauty is in the eye of beholder. Valuation is in the eye of investor. If you are investing with 1 year horizon, maybe you will find something expensive. If you are investing with 5-year horizon, maybe you will find it not expensive. Second, within the sector, it is always the promoter which makes the difference. You need to make money through good company in a good sector, run by a good manager. Otherwise, manager सारा पैसा घर पे लेके जाएगा, minority shareholders का कुछ होगा नहीं. Within those caveats, right now, mid-cap does look little bit higher from historical average valuation, but every rule has an exception. Number two, yes, mid-caps are illiquid compared to large caps. But as of today, all the mid-cap portfolios across large, mid and small cap funds is about 22 to 23% of float available. And we are talking about float, not the market cap. The collective mutual fund holding of entire market cap put together is about 8 to 9%. There's still 92% which is not with us. So yes, it is a challenge, but that's why we have to manage it. And we think we are at a stage where we can still reasonably manage. Of course, you would like to buy mid-caps at March 20 valuation, but then there should be FPIs who are willing to sell at those prices. Now, they have also become smarter and they are not selling desperately. So you have to pay a fair price in today's market to buy the portfolio. But most of us are spreading our investments to ensure that there is enough liquidity so that we can pay our redemptions, which are on a daily basis. We are by and large investing in companies with real businesses run by good managers, and regulators have empowered us to ensure that governance standards continue to remain better. So hopefully we will be still able to create value in mid-caps. And as Naren mentioned, on a 1-year basis, 3-year basis, we have underperformed benchmark indices because there are certain stocks which have run up with limited float and so on and so forth. Hopefully those things will get corrected over a period of time.
Okay, so that's the take on valuation. Mihir, you want to comment on this in terms of, like, to his question, the mid-cap pockets where there is still some value, where there's still potential upside. What do you see, if at all?
Sure. The thing is that we talked about, Indian economy growing, and the segments in which there is growth which is superior to the rest of the economy, the higher growth segments, like it or not, they happen to be in the mid and small cap space. Large caps will not give you exposure to, say, a very large exposure to, say, to the defense sector or the railway capex theme that we are talking about, electronics manufacturing we are talking about. We are talking about the fact that government is still going to spend a lot on road building, on government building infrastructure, etc., capital goods. The private sector investment theme is just picking up, real estate. So most of these segments, if you are the highest growth segments in the next for the next 2, 3, 4, 5 years, and if you want to get exposure to these segments, you don't have a choice in the large
You
cap
have to be in
segment.
mid-caps.
Yeah, exactly.
And then you have to pay top dollar
Exactly.
to get it.
And we said that, right? If we expect these segments to deliver higher growth than the rest of the economy for the next 3 to 5 years, then they will continue to trade at some premium. The question is it too much premium or some premium? You know.
That's the fine answer wherein, fortunes really lie. In terms of midcaps, I think there's one more question. Devendra, you had a question, I believe, if you can pass the mic. You had a question on midcaps as well?
Yes. Thank you, CNBC and Surbhi ma'am. It's a pleasure to be.
Glad you could join us.
Sir, season's greeting to all of y'all. Would just like to know that by default, retail investors majorly are in mid caps. And then even if you track the results, what is the best way to be a long-term investor and track the company's record onto quarterly basis results and everything? So we don't end up in a carnage, because mid cap can take just 5 days and you are half the value of it from your entry price. So I would like to know, to throw some light on it, ma'am.
Yeah, that's a great question, I think, and thank you for asking that. I mean, while you're investing, taking on more risk, paying top dollar, high premium, getting into mid caps, how do you avoid getting burnt? Who wants to take that? Naren, you want to go first?
No, I think basically that's why you come into a mutual fund, so that you avoid this. And the risk is also higher in mid cap and small cap and much lower in large cap, which is the reason why we believe in flexi cap over these things. But the reality, having been in the markets for long, the single first rule what we have seen is, if you invest in dividend paying companies which have been steady, then you avoid some of the mistakes. Like I was an infrastructure fund manager in 2007. If you invested only in steady dividend paying companies, you avoided many of the companies which went bankrupt. So if you avoided many of the leveraged companies, you avoided the worst companies. So the simple rule is stay with lower leverage companies, stay with companies which pay dividends consistently. That will avoid you to miss some of the big disasters. So if you see the worst disasters of 99 to 2001 and 2007-8, you had to avoid these two. That means you stay with dividend pay and stay with low leverage companies. But the best way is come into a flexi cap fund and come into a mutual fund.
Well, thank you so much. He's let us in on a little bit of that secret, right? High dividend paying and low leverage. So thank you very much for that. We do have to take a quick break on that note, but the questions will continue and our market masters will keep answering them. Back in just a moment.